So, how should you invest in a low return world? And I've come up with 6 possibilities. I put them up here, and I'm not aware that there are any others. Number 1, invest as you always have and expect your historic returns. Well, that's actually a fake, because nothing, in my opinion, offers the return that it historically has offered. So that's a red herring. I just want to make sure I had your attention. The second one, invest as you always have and settle for today's low returns. That's more like it. That's more realistic. That's more prudent. It's just not much fun. And for many organizations, it doesn't fit the business plan. The third is to reduce your risk to prepare for a market correction and accept still lower returns, and that's even less fun. The fourth is to go all the way towards defense, go to cash, accept a return closer to zero, and wait for a better environment to put that cash to work. That's very challenging because, going to cash is an extreme action for an active investor. And not only do you have to be right, but you have to be right quick. Because if it takes you 2 years to be right, you'll have dug a hole that if the market keeps going up in those 2 years and you were wrong to go to cash, you'll have dug a hole so deep you may never get out of it. And by the way, you may not have a shovel anymore because you may have lost your job. So that's number 4. Then there's number 5, which is to do the opposite, to take on more risk in the low return world in order to try to get the returns that you used to get with safety. That has obvious merits and demerits. And number 6 is to put more into what you would call special niches and special people. That is, bet more on alternatives, non-market, private, and hopefully skilled managers. Now, the important thing is that none of these alternatives is completely satisfactory. Every one has a downside, including number 6, because you go into special asset classes with what you believe are special managers, and you expose yourself to manage your risk. The risk that you thought you were finding somebody with alpha, but he or she actually turns out to have negative alpha and underperforms. So, as I say, none is completely satisfactory, but I think there are no others. So now let's talk about pursuing superior returns through number 6. According to the efficient market hypothesis, which I was taught here at Chicago, there are no mispricings to find and no such thing as the skill to find them. That is to say, you can't beat the market. You can't have alpha. You can't contribute through active management. And that means that an investor's return will be nothing but the product of the market's performance and the portfolio's degree of sensitivity to that market performance, systematic risk, or what we call beta. Market times beta. Performance is alpha, manager skill, plus beta times the market's return. Efficient market hypothesis is there is no such thing as manager skill, so it's all beta times the market. And if that's true, then the only way to try for a higher return in an efficient beta market is to take on more risk. And for the reasons described earlier, today's beta markets generally offer unusually low prospective returns. You have to decide for yourself whether you accept these as the premises. There are really only 3 ways to strive for high returns in a low return world. Increase your risk, as just described. Rely on getting lucky, or locate inefficient markets where it's possible to profit from alpha or personal skill, and of course, locate managers who have that alpha. The mere fact that a market is an inefficient market, and by the way, I believe that A, there are no markets which are perfectly efficient, and B, there are markets which offer inefficiency. That's the ones we try to work in. But people say, oh, I'm going into XYZ because it's an inefficient market. Merely going into an inefficient market does not mean they hand out money. It doesn't mean that everybody goes into that market and makes an above average return or an above average risk adjusted return. What it means is that unlike the efficient markets where there's no such thing as skill or unskill, and as a consequence, everybody performs about the same in the long run. In the inefficient markets, their prices deviate from fair value. So there is scope for a superior manager to do above average through the application of alpha, or an inferior manager to perform below average due to the presence of what you might call negative alpha. So these are the ways to have superior returns. And I believe that in order to participate in active management, which is why I suppose we're all here, who here manages an index fund? Not too many. Okay, so we're all active managers. We all think that we can make value accretive decisions. In order to do active investing, it has to be based on the belief that A, markets exist that are less than fully efficient, that offer the possibility of superior risk-adjusted returns, and B, there are people with the skill to identify the bargains and add value by actively managing assets. If you don't believe both of those two things, then you shouldn't be an active manager. But pursuing alpha is not risk-free. Engagement in active management has to be based on the belief that those two things exist. But pursuing alpha is not risk-free. Inefficiency only means that asset classes, as I mentioned, are able to deviate from fair value, not that they're always bargains. Assets can be overpriced as well as underpriced in an inefficient market. Clients count on alpha managers' abilities to tell the cheap ones from the expensive ones. The potential for choosing the wrong managers introduces manager risk into the equation in the inefficient market categories. Thus, there is no surefire way to access high returns in a low return world, even in alpha markets, as should be expected. One of the underlying beliefs of my philosophy, and I hope of yours, is that most of the time they don't give away money for nothing. That's what the efficient market hypothesis really says. But the question is, will you try?